What I want to do with this video is begin the chapter and the slides about exchange rates and the foreign exchange market. You can see this file has a very large number of slides, and we will cover many slides in this video, but this video will focus on a lot of factual content. Because it is factual, it is not going to require a lot of critical analytical thinking. These are just facts that you should know, especially if you want to work in the foreign exchange market. And this chapter builds on the previous chapter in the following way. The previous chapter introduced balance of payments and national income accounting, where we describe all of the possible international economic transactions that one economy can have with the rest of the world. And we can arrange or classify these transactions into purchases for goods and services, which will be on the current account, income earned from existing assets, which is also on the current account, as well as the buying and selling of assets. That's on the financial account. In general, the topics that we're going to cover can be summarized here. And the transactions that I mentioned from the balance of payments, buying and selling goods, services, and assets, they all give rise to demand and supply of currencies. One will be demanding one currency, that is to say, you want to buy one currency, and you pay for buying that one currency by selling another currency. The ratio at which you exchange these quantities is a price. Prices are almost always fractions because it's something for something else. And we call this price for this good, money, in this market, the exchange rate. And this money is rarely going to be a literal piece of paper like this, or a literal piece of paper like that, or a literal piece of paper like this one. Rather, this money is going to be usually a bank account in a particular currency located in a bank, and the ownership of those funds will be changing. Now, when we say that the exchange rate, the price of one country's money in terms of another, is the exchange rate, we should recognize that creating a price for this particular item, this piece of paper, that piece of paper, that piece of paper, this is going to be a little different from markets you may have studied in the past, where we talk about something that is clearly not money, like these headphones or these sunglasses, the buying and selling of which will involve this piece of paper, or that piece of paper, or that piece of paper. And this can give rise to some confusion. And this slide aims to reduce this confusion, because I remember getting very confused about this as a student. And you may also have some confusion. So I want to clear that up by considering some examples. And because the US dollar has for a very long time been a very important currency in the world, and still may remain important, though we don't know for how much longer, it makes sense to use the US dollar as a specific currency. And you can certainly talk about US dollars per foreign currency. You can also talk about foreign currency per US dollar. Recall that the exchange rate is the price of one country's money in terms of another. So when we talk about US dollar per foreign currency, or foreign currency per US dollar, which one of these formulations of words is the price of the US dollar, and which one is the price of the foreign currency. Now, I encourage you to pause this video briefly and to think about this on your own. Of course, I'm going to give you the answer, and you may already have the answer, but if you think about it yourself, the answer will remain with you very firmly embedded in your body, in your mind. So the best way to understand this, in my view, is to think about the price of a sandwich, or the price of some fried rice, whatever you like to eat. The price of a sandwich can be described as so many dollars per sandwich. And when you have these words, dollars per sandwich, sandwich is the good that you desire, dollar is a good whose function is to denote the value of the sandwich, so that the sandwich and any other good can be compared. Now, you may or may not know that the word per in English suggests the line of a fraction. And here's a very obscure word, but you can impress your friends by knowing it. Solidus. The line of a fraction, when you write it this way, is called a solidus. And you can see, indeed, the price of a sandwich is a fraction. You have the sandwich in the denominator, the lower part, and in the numerator you have the dollar, the good used to denote the value of the sandwich, which is in the denominator. Now, it would be intellectually correct to talk about how many sandwiches can be purchased per dollar earned. And if you were studying labor economics, you might very well do this. But normally we don't. So the expression US dollars per foreign currency denotes the price quoted in US dollars of a unit of foreign currency. And we will say US dollars per foreign currency is the direct or American quotation from an American perspective. Because if you are taking the American perspective, your home currency is the US dollar, and it's something that you must be using in order to acquire something else, the foreign currency. The expression foreign currency per US dollar would be the price quoted in foreign currency of a single dollar. So note that we say foreign currency per US dollar is the price of a dollar because dollar comes after per. US dollar per foreign currency is the price of foreign currency because foreign currency comes after per. The thing after per is in the denominator. The thing before per is in the numerator. If it's in the numerator, it is the numéraire. It is the good whose function is to denote the value of other goods. It is not the good that is deliberately bought and sold. Though later I will say, in a sense, it also is that, but that's a different story. Anyway, foreign currency per US dollar constitutes the indirect or European quotation from an American perspective. In this class, unless I say so otherwise, assume that E represents the domestic currency per foreign. So D per F, D over F. Always remember that. Now that we've understood what is the definition of E, we can talk about using the exchange rate to convert the prices of one good sold in two different markets, where each market has a different currency. So here's an example from the book. Imagine there is a sweater produced in the United Kingdom, where the currency is Great British Pound. And imagine the price of this sweater is £50. We would like to know what should be the price of this sweater in US dollars. And the answer is a simple arithmetic problem. You multiply the price of the sweater in pounds by the price of a pound in terms of dollars. And you can see I've written things out with specific units here to enforce for you the following fact, that the units matter. you have the price of the sweater. So because this is a price of a sweater, sweater should be in the denominator. What should be in the numerator? The good used to denote the value of the good in the denominator. In this case, because the sweater is a British good, you need British currency in the numerator. Now our goal here is to understand the price of this sweater in terms of dollars. So you have to set up the arithmetic problem in a way to get rid of pounds and introduce dollars. Rules of fractions that we all learned in primary school will say that if you have something in the numerator and you want to remove it, you should multiply this fraction by a fraction with the thing you want to remove in the denominator, because then you have pounds divided by pounds, that equals 1. Those units are gone. And you would introduce instead the item you want in the numerator, which is dollars. So you have dollars per pound times pound per sweater. Pounds divide out, you get dollars per sweater. That is the remaining units. That is how you can interpret this number, 75. So this is the dollar price of the sweater under this exchange rate. But exchange rates can change. Let's suppose that one day the price of a pound goes from $1.50 to $1.25. The price of the sweater is unchanged in pounds, and we see that the price of the sweater in dollars changes. Instead of $1.25 per pound, the price of a pound might be $1.75. And in that case, we would see the price of the sweater would also change. So here I have introduced two possible changes in the foreign exchange market, going from $1.50 per pound to $1.25 per pound. That's one type of change. A second change is going from $1.50 per pound to $1.75 per pound. That's a second change. In both cases, the price of a pound in terms of dollars changes. In the first case, the pound is worth fewer dollars. The pound is worth less. And if the pound is worth less, we would say the pound experiences depreciation, because the number of dollars you need to get a pound, or the number of dollars you earn by selling a pound, goes down. And if the price that you have to pay for a pound, the price in dollars you have to pay for a pound, goes down, then the price in dollars you have to pay for a good denominated in pounds will also go down. We saw that here. In contrast, if the pound goes from costing $1.50 to $1.75, then we say that the pound has appreciated. The price of a pound is higher. The pound is worth more. And re-asking the third bullet question, we can see, by understanding, as well as the example here, that when a pound becomes more expensive in terms of dollars, pound-denominated goods also become more expensive in terms of dollars. And as one currency is appreciating against another, what is happening to this another currency against the first one? If 1 pound goes from costing $1.50 to $1.25, what is happening to the price of the dollar? Well, recall the price of a pound is dollars per pound. The price of a dollar will be pounds per dollar. Pounds per dollar is the reciprocal of dollars per pound. And I think you can understand, again, from your elementary school, from your primary school, how one fraction falling in value is different when you look at the reciprocal of that fraction. The participants in the market where these prices are developed and change very frequently, they are usually businesses. They are businesses like these. Maybe a central bank is not literally a business, but from the economic perspective, it might as well be. Individuals, such as you, such as me, we play a very small role. So if we, let's say, have this, and we want to go buy this and pay for it by selling this, we are not going to have a lot of presence, and our behavior is very minimal in this market. I found in a book a very nice graph or diagram to show how the foreign exchange market works. At the heart, you have major banks who buy and sell currencies amongst each other, hence interbank. And these banks are mainly acting among themselves. There may be some large companies that are playing a direct role. These banks will use other participants, namely brokers. I will discuss brokers later. And they will use an online platform. There are two platforms that usually get used. And then at the periphery, you have other people, other participants who occasionally may participate in the Forex market, but will not do so on a regular basis. And commercial banks are at the center. They are the ones that do most international buying and selling of currency. And again, they are not taking suitcases of these and exchanging them for suitcases of these. Rather, there will be bank accounts that they hold, for which they are custodians, denominated in different currencies, and they change ownership of these. Sometimes very large companies, whether they make goods and services like IBM, or they buy and sell other assets, they also will have a role to play directly, going toe-to-toe, side by side with major commercial banks. I found in a book, admittedly an old book, information about which banks are most active in the Forex market. So this is from Euromoney. You can see that at top you have some of the most well-known banks. I have tried to update this, but for better or for worse, Euromoney does not make their data readily available. So the best I was able to do was to get 2022. And you can see here, let me zoom in a little bit, the banks that get mentioned, the top three, Deutsche Bank, UBS, JP Morgan, they are very similar to what we see here. There are some new players like XTX Markets. This looks like a financial trading company, not a bank. So there you have some basic information. This is just to give you a closer idea about things. So how would a participant, an active participant in this market, a bank, actually go about buying and selling? What would they be doing? Why would they be doing it? Well, suppose that ExxonMobil needs to pay 160,000 euros to a German supplier. Well, ExxonMobil would call up the bank, who acts as an agent on behalf of ExxonMobil, the principal. ExxonMobil would tell the bank, I need 160,000 euros. I need them sent to this German company. what will this cost me in terms of dollars? And assuming that ExxonMobil trusts Third National, ExxonMobil will say, just take out from our account the number of dollars that we need to get the 160,000 euros. And Third National might look at the market, might look at its underlying assets, and then decide that the cost, on average, of €1 will be $1.2. So in total, getting the 160,000 euros for ExxonMobil to go to the German supplier will cost $192,000. The final result will be a transaction where Third National will take $192,000 from ExxonMobil and then use that to deliver 160,000 euros to the bank where this German supplier has an account. This is what banks do. Banks exist to help companies fulfill and manage their financial needs. And banks do this with other banks as their counterparties, hence the phrase interbank trading. And when banks are working on behalf of these corporations, it should not be a surprise that these banks are buying and selling enormous amounts of money. So if I go to Google and I say 1 USD to euro, and I learn that right now, according to Morningstar, the price of $1 in terms of euros is 0.85 euros, I am seeing a price for the dollar that I can get if and only if I am buying or selling at least $1 million. I cannot go to a bureau de change, take this $1 and get 85 cents. If I try to do that, I am going to get a lot less than 85 cents. That's because the bank knows that I am not so important compared to a corporate customer, and therefore the bank will give me far less than 85 cents in exchange for my $1. Banks do this because, as I say here, they already have well-established expertise for finding counterparties in financial senses that satisfy the needs and wants of their customers. Another example from the book is that a multinational corporation might receive US dollars, they have revenue in dollars, but they might have some liabilities, some costs, expenses in terms of krona, Swedish krona. Now, in principle, there is nothing to prevent this corporation from going to other corporations, asking them if they have krona and are willing to take krona in exchange for US dollars, and then comparing all these possible offers. But if you're a company that makes tires or cars or boots, you don't have the expertise in-house to figure out what's a good deal, what's a bad deal, to know regulations about moving money across borders. You want to rely on some expert who does this 8 hours a day, 5 days a week, at the very least. Banks have that expertise. Now, if you are a very large corporation and you frequently make or receive payments in a currency other than that of the currency in which you operate, you may have your own full-time staff to do this so that you don't have to rely on another bank. So let's say that IBM has a factory in Mexico. It will have to pay its workers in Mexican peso. If IBM books its revenue primarily in dollars, then it will have to sell the dollars to buy pesos to pay its workers in the Mexican plant. And if IBM regularly gets revenue in dollars, regularly has these costs in terms of pesos, IBM may think it's worthwhile to have its own staff doing this rather than paying any fees to a bank. The companies that do goods and services trade, or even financial trade, that will have their own Forex staff, they are only very large multinational corporations. So in the set of all companies in the world, the companies that have their own staff doing this are a very small share. When banks or other firms have people who do the buying and selling, they are first and foremost the dealers. And the dealers are the ones who, at the end of the day, are the most important people. And they not only work on behalf of the company employing them, the bank or IBM, they are also people who are making a market. That is to say, if they need to, let's say, buy a certain currency, they will be willing to put their own currency out into the market in order to make sure that there is going to be a counterparty who will take that. And dealers always operate according to buy low, sell high. In this class, if you get confused at some point about what someone should do or why someone is behaving in a certain way, 9 times out of 10, you can explain their behavior with buy low, sell high. Dealers are the ones who are always going into the market and offering something and seeing if someone else meets them as a counterparty. But dealers may not work alone. They may engage a broker. Brokers act as, let's say, agents on behalf of the dealers who are employed by the company or the bank. Brokers will not put their own money at risk. Rather, they will find a counterparty for the dealer, and the broker will charge the dealer a fee for the efforts of the broker. And brokers will typically have many lines of communication open to multiple dealers, and they will let the dealers know where to get the best deal. Dealers like this arrangement because brokers can help give dealers and the dealers' companies anonymity in case there's a very large position, a very large transaction that might put the company or the bank at a disadvantage in the market. Here is an example. Suppose that Citibank, at the end of the day, or near the end of the day, finds itself with a very large amount of Aussie dollar. The Aussie dollar is not a very prominent or important currency. It doesn't have a lot of use outside Australia, New Zealand, and Pacific territories. Citibank would like to sell this Aussie dollar for US dollar before the end of the trading day. But think about what could happen if Citibank finds itself with a very large amount of a not popular currency. Do you think that Citibank can get many US dollar for these Aussie dollar when it has a lot of Aussie dollar and Aussie dollar isn't so popular? Probably not. If there were no anonymity, i.e. if people knew publicly that Citibank had an unusually large amount of Aussie dollar, people considering buying the Aussie dollar from Citibank would be unlikely to give many US dollars for this large amount of Aussie dollar. Effectively, if you had a transaction with no anonymity where a counterparty was using the uncomfortable position of Citibank to Citibank's disadvantage and the counterparty's advantage, that would mean a small amount of US dollar becoming equivalent to a large amount of Aussie dollar, which would make the US dollar in that transaction very valuable, and each Aussie dollar in the transaction very low. Citibank doesn't like that. That's what would happen if Citibank just called up JP Morgan and said, I have an enormous amount of Aussie dollar. How much USD can you give me for it? Instead, Citibank can use a broker who can go around and find other people who may need Aussie dollars. So if the Aussie dollar is not so popular, maybe you won't find one person who wants a large amount of it at once, but you may find multiple people who want a moderate or small amount, and you can add all those up to find enough people to whom you sell the Aussie dollar, you buy USD, you do this at a reasonable price, and that helps Citibank not lose money. More on the subject of brokers. This is just a series of history that talks about how brokerages work now that we have online trading. I'm not going to ask you about this, but if you are interested in working in Forex later, you may want to know some of these things, how the actual transactions get taken. The two top traded currency pairs, dollar euro, dollar yen, trade on EBS. Third most traded pair is dollar pound, that's on Reuters. Dollar pound is also known as cable. I believe that's because when international financial trades became electrified in a sense, it was through telegraphs, and there were telegraphic cables that went under the ocean, and this would have been in the 20s when London was still arguably the financial center of the world. New York was gaining on them. So dollar pound was quite important 100 years ago, and because it went through a cable, I believe the trade is called, to this day, cable. Anyway, you have these facts. So those were banks. Other participants. The interbank market used to dominate Forex, in part because banks worked on behalf of companies for goods and services, and until maybe the 1980s, international finance was highly regulated. After the 80s, after Thatcher and Reagan, that changed a lot, and now interbank participation is a relatively smaller share of the pie, and almost 48% of the total volume is now undertaken by other financial institutions. What is an other financial institution? You see examples here. As I said a few moments ago, before the 80s, international trade in goods and services was the main source of non-bank demand and supply. But now that we have a lot more financial account activity, buying and selling assets, companies that do this buying and selling of assets, the ones mentioned here, they have a much larger role. And finally, central banks. On a daily basis, no central bank usually plays a large role measured in terms of volume. But when a central bank decides to interact, to enter the market, they are doing so with a goal in mind, because they do so with the intent of establishing a price in the international market that everyone will respect and that nobody can change, no matter how hard they try. And we will see throughout the term, especially in economies such as China and Singapore, also Hong Kong. Hong Kong doesn't have a central bank, well, neither does Singapore. They have monetary authorities. Monetary authorities, for all intents and purposes, are central banks. These organizations act on behalf of their governments to achieve certain goals. And in the case of China, it is not only the People's Bank of China that may do this buying and selling, but also something like the State Administration of Foreign Exchange. You can see that here. All right. So those are the actors in the market. What do we know about the market in general? Well, the market is not a specific location like, the Futai wet market. The market is a network of banks, and it is almost always open. And we're going to see that inherently, because Forex depends a lot on today's beliefs about the future, and that news can change today's beliefs about the future, any time that the news changes, the price of Forex should change. And as a result, especially because everyone is trying to make money, there is a lot of volatility and movement in these prices. This graphic is from a book that I used to use. I don't use it anymore. But you can see how, for all intents and purposes, the market is open at least 20 out of 24 hours in any given day. Pure Forex transactions are quite important in Singapore, Frankfurt, London, New York. Hong Kong, except for Hong Kong dollar trade and to some extent renminbi trade, is not so important just for Forex. Hong Kong is important for Forex primarily for the purpose of the Hong Kong stock market. Similar with Tokyo, there is not a lot of Forex for the sake of Forex trading there. Rather, it's for the sake of buying and selling on the Nikkei. Some vocabulary. This is a market. The exchange rate is the price of one currency in terms of another. Prices are the interaction of demand and supply. When you demand something, you buy it, or you bid. When you sell something, you ask or offer. In the process of negotiation, a buyer and a seller may not immediately agree on a price. The buyer wants to buy low. The seller wants to sell high. The gap between them is the spread. And when you look at how buyers act, when you look at how sellers act, the buying or bid price will always be less than the seller ask price, because otherwise people would be losing money. This spread can be incredibly small. So the spread for dollar-euro is on the order of a fraction of a cent. The larger is the spread, the more is the potential profit to traders, and we will see, and you may be able to imagine this, the larger the spread, the more quickly it will get closed. Because spreads are often very, very small numbers, and people don't like fractions or decimals, it is common to talk about a pip. So a pip is the fourth decimal point in a currency quote. So here we have first, second, third, fourth. So in this particular case, the spread between euro and dollar would be 1/100th of a pip. That's because dollar-euro trades around a value of 1. Is there a currency that does not trade around a value of 1? Yes. Japanese yen trades around a value of 100. Korean won trades around a value of 1,000. The larger the number of agents in the market, the smaller the spread should be. This is what we expect from simple, intuitive microeconomic behavior. If a particular currency market does not have a lot of participants because it's not popular, or it could be popular but there's very high risk that's making people nervous, then the spread should be larger. And when we look at the specific geographic locations in this market, Nai Kong, for example, New York, London, Hong Kong, we should conclude that at any moment in time, regardless of the time on the clock in the place where you're examining, the price of one currency in terms of the other currency should be the same. There should be no meaningful difference. The emphasis here is should. In a couple of slides, I will explain what would happen if we saw something that we should not see. Before I get to that, I do want to acknowledge that by definition, when you buy one currency and pay for it with another currency, even though you may start out on this transaction thinking about the buying, you are, for all intents and purposes, also selling. How do I mean that? Well, imagine that you have a yen-dollar bank trader who quotes a bid price of yen per dollar at which she is willing to buy dollar in exchange for yen of, say, 110.25 yen per dollar. So this is someone who wants to buy dollars, hence it makes sense to write this as yen per dollar, just like yen per sandwich. If you want to buy a sandwich in Japan, here you want to buy dollar, so dollar comes after per. The trader would then quote a higher ask price of yen per dollar, also called the offer price, at which she is willing to sell yen for dollar, say at 110.3. So this is a trader who is trying to make money buying the dollar at a low price, 110.25, selling it at a higher price, 110.3. In this latter transaction, the trade offers dollars, the base currency denominator, to the market, and is willing to accept yen in return. So, in the second transaction, as we read in bullet 3, the trader is selling the dollars that she just bought in the first bullet. So, these words on this slide, this presentation of these events, these facts, present this transaction as buying dollars, then selling dollars. Well, buying dollars and selling dollars can also be seen as selling yen and buying yen. The bid rate is the US dollar price of the yen at which the bank trader is willing to buy yen with dollars from the market, which was this transaction. The ask rate is the US dollar price at which the bank trader is willing to sell yen for dollars into the market, which was this transaction. Since buying yen from the market is equivalent to selling USD to the market, the US dollar per yen bid rate must be the reciprocal of the yen per dollar ask rate, and vice versa. Now, I mentioned on slide 32 that because of the electronic online integration of Forex markets, we should see no difference in the price of one currency in terms of another across markets at any moment in time. But just because we should not see it does not mean we will never see it. In principle, if the euro were selling for $1.10 in New York, but $1.20 in London, a trader could make profits through arbitrage, the process of buying a currency cheap and selling it dear to take advantage of profit opportunities. Buy low, sell high. Remember, if you can't figure out something in this class, 9 times out of 10, buy low, sell high will explain it. At the prices listed above, a trader could buy 1 million euros in New York, sell them in London, make $100,000. Do you think that this opportunity will be available for a very long amount of time? Not likely, because once one person starts on this, someone else will be starting on it. And when suddenly there is new demand for euros in New York, demand that didn't exist before, that pushes up the price of the euro. And we're quoting the price of the euro in terms of dollars. So 1 euro becomes worth more dollars. Then, so many people are in London now selling the euros, the supply of euro is larger than it was before. And when the supply of something goes up, its price goes down. Simple microeconomics. This would continue until there would be no motivation to take euros from New York and sell them in London. What would be sufficient to eliminate this motivation? The same exchange rate, the same price of the euro in terms of dollars in the two markets. And even if you wanted to try this yourself, you would have a few problems, because you would have to do the two transactions simultaneously. That very likely violates the laws of nature and how fast you can type and electrons going through cables. So even though you might be working very hard to find these opportunities, either through your own mind or some program, be aware that other people are doing the same thing, and that even changes in a few feet between your computer on which you do this trade and some server that sends information out around the world can determine whether you succeed or you fail. This is a very interesting podcast that looks at this problem of trying to do near instantaneous buying and selling, and the physical role and limits of technology, of computers. The market here is not Forex, the market is shares, equities, but the principle remains the same. A final word about profit. This is going to be more important if you ever arrive in a new economy, a new country, and you need to buy the local currency, the actual paper, like this or this. You'll go to a bureau de change. You'll see like an electronic board. It will list various currencies, and it will have two columns. And you may be confused about the price at which you can sell this currency to get some other currency. The most reliable way for you to know the price you have to, the exchange rate that you'll get, the most reliable way to know this is to know you will always get the worst deal of the two, because the bank always wins. If you are purchasing US dollar with yen, you have to pay the high price of yen per dollar, which is the bank's ask price for dollar. Because when you buy dollars from the bank sells you dollars. And the bank always wins, so the bank gets to set its selling price, its ask price. And if you're on the other end of the transaction, you get the bank's bid price. Okay. In principle, you can have a Forex market for any two currencies, but in practice, most transactions in this world, over 80%, will involve the US dollar. And this is information from 2022, but I have updated this, and you can see it on Moodle, to 2025, and you can see the US dollar remains behind close to 90% of transactions across different types. We'll be talking about what spot forward swap means later. And these numbers don't add up to 100 because there's it's a question of double counting, because if you have a transaction with dollar and euro, it's going to show up in both of these rows. This is true that the dollar is important even when the goal of a participant, a bank, is to sell one non-US dollar currency, like this one, and get another non-US dollar currency, like this one. The book has an example of, let's say, Swiss francs and Israeli shekels. There may be people in this world, enough people to form a good market, who are willing to buy shekels for Swiss francs and vice versa, but there really aren't many. And it is often easier for a bank just to, let's say, sell Swiss francs for dollars, and then take the dollars and use the dollars to buy Israeli shekels. This gives rise to the phrase vehicle currency, and I'll mention that a little later. So vehicle currencies are useful for undertaking transactions in a practical sense, and they will imply an exchange rate between the shekel and the franc, even if there is very little direct trading at this price or in this market. But the trades happen indirectly, and again through arbitrage, the price would have to be equivalent to this, because otherwise there would be some opportunity for profit. Here are some more things about vehicle currency. I showed you the update on Moodle, so that's all I have to say there. Now, for timing. So, the foreign exchange transactions that we have been discussing take place on the spot. In English, the phrase on the spot means immediately. But in Forex, on the spot can be up to 2 days. Why up to 2 days? You need 1 day for the paperwork and 1 day to account for time differences. The price that I showed you earlier here, this is a spot rate. This is the spot price of the dollar in terms of euro. If you are looking at currencies within North America, spot rates get settled in 1 day because it's effectively the same time zone. Little piece of trivia: in certain countries where Islam is an important religion, Friday is not part of the business week. So if you did a transaction with one of these economies on Wednesday, it would get settled only on Saturday, not on Friday. So anyway, spot. Spot is the most intuitive way to think about the foreign market, the foreign exchange market. But sometimes you want to make certain today the price of getting some currency, and you want this currency not now, but later. There is a separate market within the Forex market for this. It is called the forward market, forward in the future. And there are prices for the delivery of these currencies at any date in the future, though some are more common than others, 30, 60, 180, etc. And the prices are called forward rates. So how would a forward rate work? Well, two parties on the 1st of April, no joke, may commit to trading amongst themselves £100,000 for $155,000 on the 1st of May. That implies a forward rate of $1.55 per pound. That price will generally differ from both the spot rate on April 1st, but also the forward rate you see on April 1st for 60, 90, 180. When you agree to sell pounds for dollars on a future date, when you make that agreement today, you are selling pounds forward and buying dollars forward. And the date on which currencies are exchanged, which in this case was May 1st, we call that the value date. Why does this market exist? Well, suppose that Best Buy, which is an American company that sells electronic goods like headphones or tablets, suppose that it knows that in 30 days it has to pay yen to a Japanese supplier for headphones that will arrive at that time. And Best Buy intends to sell these headphones for 100 American dollars each, and it has to pay 9,000 yen per headphone. The profits of Best Buy are going to depend on the exchange rate because it's getting revenue in dollars, but it's exposed in yen. It has costs in yen. If Best Buy looks at the current spot rate and sees that 1 yen costs a little over a penny, Best Buy would know that it's going to need to pay $94.50 per headphone, which means it would be earning as profit $5.50 on each headphone. That's fine, but Best Buy is not going to have money until after the arrival of the headphones, when it sells the headphones. And there could be a problem. In particular, the dollar could be worth fewer and fewer yen in the future. The yen could be worth more and more dollars. Here we see the yen is worth a larger amount. Yen used to be 1.05 cents. Now it's 1.15 cents. If this were the spot rate 1 month later, Best Buy would be losing money. How can Best Buy avoid this? It can enter into a forward contract for delivery of yen in 30 days, and its counterparty would be Bank of America. So Bank of America, knowing that this is a service that is valuable to Best Buy, and also maybe having its own reason to believe that the yen will be appreciating over time, would tell Best Buy that Best Buy today can guarantee delivery of yen in the future by paying 1.07 cents per yen. That would imply the cost in terms of dollars for each headphone would be $96.3. This certainty may be attractive to Best Buy, and agreeing to this contract can guarantee Best Buy a particular amount of profit and can reduce exposure, which is to say hedging risk. And when we talk about hedging risk, we talk about reducing exposure to risk. In practice, as a matter of how these markets work, the bank will require some sort of deposit from Best Buy, compensating balance. The spread in the forward market is usually wider than the spread for the spot market, and the longer is the duration, the wider is the spread, usually. A few more definitions. If the forward market implies that the currency is going to appreciate, so for the yen, in this case, there was a forward premium, and for the dollar, there was a forward discount. In the unlikely but possible chance or case where spot and forward rates are equal, we say the currency is flat. Bid-ask spreads are larger in the forward market than in the spot because usually there is less liquidity in the forward market than the spot market. And to explain that, and to also show why forwards alone are not enough to hedge risk for all parties, let's look at this example. So let's suppose that there is a Canadian company, Canada Beer, and let's suppose that it exports beer to the US and receives regular payments in terms of US dollars. And let's suppose Canada Beer enters into a 30-day contract to sell $1 million American dollars that it will earn in revenue in exchange for Canadian dollars that it needs to pay its workers. So Canada Beer is selling its revenue forward, its US dollar revenue forward for Canadian dollars. And for simplicity, let's say that the price of a Canadian dollar in the forward market is 90 American cents. Once Canada Beer and Bank of America sign this contract, Bank of America will be short Canadian dollars in the forward market, meaning Bank of America has to give up Canadian dollars in the future. And Canada Beer is now long Canadian dollars in the future and short US dollars in the future, because Canada Beer will be getting Canadian dollars and giving up US dollars. So long, this is what you're going to get. Short, this is what you have to give up. I think a good way to remember this is to recall that in English, saying I'm short for something means I'm supposed to give something to someone, but I don't have this thing. So when you remember the use of short in that context, I'm short $20, it means you have to give someone the $20 and you don't have it. The key thing is you have to give it to someone. And once you know that short is something leaving you, you know by kind of reverse property, long is something coming to you. From the Bank of America's perspective, in 30 days, BOA has to deliver some Canadian dollars, and they will receive US dollars. So Bank of America is going to be short 1,111,111 Canadian dollars, and it's long $1 million USD. Seems okay, but what could happen to the loonie US dollar market in those 30 days that would pose a downside risk? Here we can see Canada Beer, they have a liability to BOA, but they have a corresponding asset, and they have an additional asset. Canada Beer looks nice. Bank of America, they have an asset, they have a liability, but these are different currencies. What if this liability becomes worth more in terms of US dollars than is the asset? That is risk for Bank of America. Now, in principle, if the forward market had enough liquidity, Bank of America could, do something to protect itself. And Bank of America, realizing that it has to give up all these Canadian dollars and isn't sure yet how expensive that will be, they might want to close their position by guaranteeing for themselves a forward delivery of Canadian dollars. The next couple of slides imagine a situation where Bank of America realizes this third bullet too late, just to illustrate why the forward market by itself is not enough. Suppose that one day after BOA signs the contract with Canadian Beer, BOA sees the spot rate increase. That is to say, the Canadian dollar is now appreciating against the US dollar. BOA may suddenly feel that the risk of being short Canadian dollars is not worth taking, and they try to balance that liability by going long Canadian dollars in the interbank market with a 29-day contract. Well, if you see the spot rate increasing, in this case it means the Canadian dollar is now worth more US dollars, and therefore under these prices, getting the 1,111,111 Canadian dollars would cost BOA 1,022,222 American dollars. So this is going to be a liability for BOA, and in the same currency, their asset is only $1 million USD. Because BOA waited one day to close its position, to hedge its short position, it lost $22,222. There are other reasons why Bank of America might be concerned in this case. Bank of America is expecting that Canada Beer will deliver US dollars to it in exchange for Canadian dollars that Bank of America gives to Canada Beer. What if Canada Beer goes bankrupt? That's a default risk from the perspective of BOA. If Canada Beer is not delivering USD, then BOA does not need to deliver Canadian dollars to Canada Beer. And Bank of America was counting on having these US dollars in its portfolio, not extra Canadian dollars. So this goes to show that Bank of America, when it is entering into this forward contract with Canada Beer, needs to hedge the transaction that it just agreed to provide with Canada Beer. If Bank of America does not want to build up an inventory of Canadian dollar, it will have to sell Canadian dollar for USD in the spot market if Canada Beer defaults, meaning Bank of America got the Canadian dollars it was going to sell to Canada Beer. Canada Beer suddenly went bankrupt. Now Bank of America has these Canadian dollars that it doesn't want, so it has to get rid of them as soon as possible, and that will be at the dictates of the US dollar. This spot transaction would occur 28 days later. It would settle 2 days later at the forward contract with the bank counterparty. So currency risk would reappear because the future CA-US exchange rate could be disadvantage to Bank of America. So forward contracts, just by themselves with nothing else, are unattractive for these reasons. And instead, what participants will engage in are swaps. Swaps are simultaneous spot and forward transactions that, in some sense, are the opposite of each other. Swap would be a spot sale combined with a forward repurchase, or involve the purchase of a foreign currency short-term against the sale of the same currency long-term. Why would this happen? Well, suppose that a portfolio manager wants to invest in the bond and equity markets of foreign countries without being exposed to changes in the values of those currencies. Because to buy foreign equity, you have to buy the foreign currency in the spot market. So if I want to buy stocks in Shanghai's stock market, I would first have to buy renminbi. But maybe I anticipate selling the renminbi stock at some point in time. That would give me more renminbi, but I care about this currency or this currency, and I want to make sure that when I sell the renminbi, I will get enough of this currency or that currency. Swaps help me to do that. As an example, suppose that Toyota receives $1 million from American sales. It knows that it has to pay those dollars to a California company in 3 months, but there may not be any US dollar asset short term that is very attractive for Toyota. Maybe euros offer much more attractive assets. Well, Toyota could sell the dollars for euros today in the spot market, but then sign a forward contract to guarantee the conversion of those euros back into dollars at a price that eliminates risk. This is a very attractive offer, and that's why swaps make up a very large share of all transactions. Banks can also use swaps to change the maturity structure. So if a bank is short Swiss francs over 6 months in the amount of $1 million, and the bank wants to stop worrying about this after 3 months instead of 6 months, then the bank can enter into swaps to buy $1 million to sell its existing position in 6 months, and then it will be selling the Swiss francs in 90 days, and therefore it ends its obligations on its terms. And a swap trader can settle this in 1 attempt as opposed to 2 attempts. So swaps are very popular. And again, if you want to go into Forex trading as a career, you should be aware of them. For the rest of this video, just about 7 more slides, I just want to mention other future-looking transactions. And I hesitated to use the word future because future has a very specific meaning in the forward market. There is a contract, a transaction called a future. A piece of paper, a currency that guarantees delivery of Forex in exchange for other Forex. That contract is called a future and can be bought and sold on organized exchanges. When you buy a futures contract, you buy a promise regarding the delivery of a certain amount of currency at a specific date. And this is an alternative way to handle forward trading. Once you sign a forward deal, you have to follow through on it. Whereas if you want to get out of a forward contract, or you think you might want to get out of the forward contract before you sign it, then you might want to sign a future instead. Because if you suddenly don't want to buy or sell the currency in question, you sell the entire contract to some other party, and that party deals with the transaction. That's if you think you might be revising your belief about spot rates in the future. Here are some facts about futures. They are centered in Chicago in the United States, in part because Chicago has for a long time been the center of trading agricultural goods in the United States, wheat, corn, oranges. And Chicago is the center of this because Chicago was close to the Great Plains, the prairies of the US, lots of farming. And when you farm, you get the product only at a certain time of the year. But people, any day of the year, may be interested in buying or selling this product. And that's how futures markets evolved generally. And it's not surprising that when people decided to do this for currencies instead of commodities, they drew upon the expertise that already existed in Chicago. Often futures get bought and sold for speculative purposes, and in the remaining videos for this chapter, we certainly will talk a lot about speculation. Finally, a few things about options. Options are like futures, but you are not required to follow through on it. You can buy and sell the option, but even if you own the option and you don't want to use it, you don't suffer anything. There's no obligation to exercise the right, as you see here. Options are most useful when you have a high level of uncertainty about how the market for the currencies is going to work. Here are some more things about options. They started out trading in the Philadelphia Stock Exchange, which is now part of NASDAQ. You see here some basic data. I'm not going to ask you much about options, so I'm speeding through this. But if you are really interested in this, I can give you some more information. So the last video was very long, but it was very fact-driven, and that's why I felt it was fair to get all these details about the foreign exchange market done. The video that you just watched was probably the most finance-like video we will have for this class. I wanted to give you a full set of details about how the foreign exchange market worked, in case you were curious about how this market plays out in the real world around us. You don't have to know, for the purpose of this class, all of those details. Certainly you will have to know about the spot swap, and forward markets, but I did want to give you other details as well. What we're going to do in this video and the next video is to talk about more theoretical, analytical things. And for that reason, this video will cover a smaller number of slides. This next video, the final one, will also cover a smaller number of slides because I want to have the topics be more contained, a little more constrained, so you can focus on them, because there's going to be some important information, some important motivation for the way of thinking in these two. And I want to start by talking about a general theoretical idea, namely what drives the demand and supply of foreign currency. In particular, as the book puts it, bank deposits, though what we're going to say would apply equally well to a bond. Let's say a bond issued by the government for which we are discussing a currency. The deposit, the demand for this deposit, or this bond, or any sort of asset is going to be the same that motivates demand for other assets, any other asset, namely its value in the future. This is what makes the market for assets distinct from the market for goods and services, namely that you buy an asset for the whole purpose of selling it in the future. When I bought these headphones, I was not thinking about how much I can sell them for in the future because I have no intention of selling them. When I bought, what else do I have? When I bought these sunglasses, I had no intention of selling them in the future, so I wasn't thinking about what the price would be in the future. For an economist, thinking about assets necessarily thinks about transferring money in the present into money in the future for the purpose of taking that money and buying goods and services. This is what will distinguish economics from finance. Finance will focus about maximizing wealth and will not give a lot of attention to what people do with the wealth. Economists will always ask, how much consumption can I have in the future? What decision should I do now to move money in the present into the future so that I can get to the future, take the money I have, and then buy goods and services? We do this in order to buy property, to send children to university, to retire. Buying property, buying a place to live when we're old and we don't want to sell, sending our children to the university, retiring, these are all economic things. And just as people may buy property based in part on the price at which they think they can sell the flat in the future, people will acquire bank deposits based in different currencies based on what those deposits will be worth in the future. And when you think about the worth in the future, you think about the price today, the difference as a share of what you pay today is the rate of return, the percentage increase in value earned over time. You often cannot know with certainty what is the return on an asset until you actually have bought it. But if there are ways to reduce uncertainty, you likely will pursue those ways, and we'll be talking about this in the final video, but you've already learned about some of them, notably forward markets. General ideas about choosing an asset. All else held equal, individuals prefer to hold assets offering the highest expected real rate of return. And real means how many goods and services can you get in exchange for selling this asset. In reality, this all else often is unequal. And two elements of assets that may differ across the set of assets along with expected real rates of return are risk and liquidity. Now, I will only say a few words about these ideas, risk and liquidity now, as well as later. Suffice it to say, most of the time, people don't like risk. And an asset with a high expected rate of return may be undesirable if the risk, meaning the variance on it, is too high. This will be important when we learn our asset market model, uncovered interest rate parity. For most of this class, we're going to study this model, interest rate parity, uncovered interest rate parity, assuming no differential risk. That's not true in reality, and I'll mention that later in the third video. And then liquidity. We're not going to really talk much about liquidity, so I'm not going to give it a lot of attention now, because we simply don't have the tools for it. Moving away from general comments about assets to bank deposits in different currencies or bonds in different currencies, participants in the Forex market will create their demand for specific quantities of specific currencies based on expected rates of return. And to know what is the rate of return, a market participant will need two pieces of information: how the nominal value of the deposit will change over time, and how exchange rates will change over time, so that a participant can look at two assets, one in one currency, the second in a different currency, and express them in the same currency to make the comparison meaningful. Because 1,000 renminbi and 500 US dollars, you can't compare 1,000 and 500 directly, because a renminbi is not a dollar. To understand how money, wealth, in an asset will change in nominal terms over time, you need to know the interest rate, which is the amount of that currency that an individual can earn by lending a unit of the currency for a given period of time. Deposits in banks pay interest because when I put money in my HSBC account, I am effectively loaning money to the bank. Bonds also pay an interest rate, and in the next chapter, chapter 4, I'll talk more about that. At this moment, I'm going to jump to the appendix, because I think if I talk about concepts in the appendix first, it will actually motivate in a better way the main model we're going to discuss. Now, let's suppose you want to buy a euro deposit or a bond in the euro with US dollars, and you would like to be certain about the number of dollars it will be worth at the end of the year. What should you do? Well, we talked about this in the previous video. You can avoid risk if, let's say, US dollar is your home currency, by buying a euro deposit. So you convert this into euros. You then take the euros, you put them in the deposit or the bond, and you can calculate quite precisely how many euros you will have at the end, and then you sell those euro proceeds forward for dollars. We talked about this when you combine a spot transaction, selling US dollars to get euros, with a forward transaction, selling the euros forward to get dollars. That's called a swap. And when you buy a euro deposit with US dollars, and at the same time you sell the principal and interest forward for dollars, we say that you have covered yourself. The swap covers you, you have hedged risk, you have avoided the possibility of an unexpected depreciation of the euro. So as an example, suppose that the 1-year forward price of euro in terms of dollars is $1.113 per euro. And let's assume that the spot rate is $1.05 per euro. So today, €1 is worth $1.05. The price today of guaranteeing €1 in the future is 1.113. So you can see the euro is going to be worth more in the future according to the forward market. Let's assume that interest rates in the US are 10%, interest rates in Europe are 4%. So the dollar rate of return is 10% for a dollar-based investor. What is the relevant rate of return on the euro deposit? Well, you have to calculate it in terms of dollars. So €1 today costs $1.05 today, and that €1 will be worth 1.04 euros in a year. Now, if you sell those 1.04 euros forward to buy USD, using the forward rate, that means that your $1.05 today will become $1.1158 in a year. So the rate of return measured in dollars on a covered purchase of a euro deposit is about 10.3%. So if your currency is US dollar, you can get a return in the United States of 10%, or you can get a return in euros of 10.3%. Which asset would you choose? Well, clearly, you would choose the European asset, the euro, because that gives you 10.3%, which is more than 10%. If you look at all these calculations and you replace the specific numbers with the general variables, the foreign interest rate from your perspective, the spot rate to convert your currency to the foreign currency, the forward rate to bring the foreign currency back into your domestic currency, you can express the covered rate of return with this product. Now, the expression here is 100% correct. However, we're not going to use this description of the return. We are going to use an approximation of this return written in this way. And I encourage you to figure out why the expression up here and the expression down here are equivalent. And I've given you a hint. The hint is that the log of 1 plus a small number is approximately the small number, and the fact that you can add and subtract 1. When you do this, you can write this expression this way, and this second expression will be more convenient. So when we are comparing different assets, if, let's say, we are US dollar-based investors, we will look at the US dollar interest rate. We will also look at the non-US dollar interest rate, but adjusted for the current spot rate and the forward rate. This expression is in terms of dollars. 10% that we saw earlier is in terms of dollars. We can compare the two, and we know that these rates of return are certain, no risk, because we have used the forward market. And in the example I gave you, one asset, the foreign one, offers 10.3%. The domestic one offers 10%. They are different. Can an economy where we have the US and Europe sustain a situation where one currency offers a 100% certain higher rate of return with no risk? This second question is very critical, and I suggest you make a big point of asking yourself this every single day. And I hope every single day your answer to this question will be no. Because if the answer to this question is no, then it means that this rate of return and the dollar interest rate of return have to be equal, or the same. There has to be parity. The rate of return on dollars measured in dollars must equal the rate of return on euros measured in dollars. Because if this expression did not hold with equality, it would mean that there was one currency continuously offering a strictly higher rate of return with 100% certainty and no risk. Where in the world have we ever seen that? The answer is nowhere. We have never seen it. Therefore, in a kind of proof by contradiction, we must, in a theoretical sense, have equality among all covered rates of return. We can interpret this bit of algebra by saying that the relative difference in forward and spot rates is the forward premium of the euro against the dollar, or a forward discount of the dollar against the euro, given the particular numbers we have. The covered interest rate parity condition becomes the interest rate on US dollar deposits, that's on the right-hand side, equals the interest rate on euro deposits, that's here, plus the forward premium on the euro against the dollar. That's the F minus E over E. Another way of saying this, if you move euro interest rate to the right-hand side, is that the difference in interest rate equals the forward premium or discount. Now note, given interest rates, which are determined in a competitive market for bonds, given the spot rate, which is determined in a competitive market, that's always changing, the forward rate must be determined exactly. And indeed, currency traders almost always use this formula to determine what should be the forward rate, because the currency trader will not choose any rate that means they lose money for you to gain. Now, on a very few occasions, the implied value of the forward rate may not match the observed value. That could happen if, for example, there were sharp differences in the risk profile between the dollar asset and the euro asset. To understand why we should not expect deviations from this formula, let's assume there's a deviation and see what it implies. Now suppose that the local economy is the dollar, the foreign one is the eurozone, and suppose that the dollar interest rate is 7%, the euro interest rate is 5%, and 1 euro is $2. Totally made up numbers, but they're just simple. The forward rate should be $2.04 per euro. Now, before we go on, I want to highlight something. In this example, the nominal dollar interest rate is higher than the nominal euro interest rate, 7%, 5%. Under covered interest rate parity, actually under any interest rate parity, this forward rate shows that the euro is worth more in the future than in the present. The spot rate says 1 euro is worth $2. In the present, the euro interest rate is 5%. The dollar interest rate is 7%. And the future value of the euro is higher. And I want you to remember this. When we are looking at two currencies and the market is in equilibrium, the currency with the low interest rate will appreciate in the future. The currency with the high interest rate will depreciate in the future. But again, that's when the market is in equilibrium and we look at the interest rates on two different currencies. We know that the forward rate should be $2.04 per euro. But what if we see instead $2.06 per euro? Our research, our formula says a euro in the future should be worth only $2.04. In reality, it's $2.06. The euro is therefore selling at a very large premium. How is that useful? Well, it means that somehow the market thinks euros will be worth a lot. And we, as researchers, as participants, could get in on this action because our research tells us that 1 euro should only cost $2.04, but many people are behaving as if 1 euro will cost $2.06. So we would like to get in on this market and sell the euro at a high price in the future. How will we get the euros? Well, we commit ourselves to selling these euros, and when we have to fulfill our commitment, we buy them up in the spot market. And because we're guaranteeing a sale, we have hedged risk. We've guaranteed a sale at a specific price. If this happened, we would expect to see lots of behavior of the type I just described. The arbitrage activity of trying to buy low, sell high would necessarily increase the spot price of the euro, and it would lower the forward rate because there would be so many more people promising to sell euros in the future. That competitive pressure would force the price of that euro down, and that would bring things back in line. It would bring the currency premium, the F minus E over E, back in line with the interest rate differential. The interest rates themselves might move as well, because as funds are moving into euro investments, that will tend to depress the euro interest rates. Those funds are coming into euros out of US dollar, so US dollar interest rates should rise. You will almost never see an opportunity like that in the real world if you become a forex trader. Rather, much of the activity that we see is based on speculation. It's based on our beliefs. And when you are a speculator, you are someone who is taking risk deliberately with the hope of making a profit. So for example, suppose that speculators believe that the Canadian dollar will rise in value over the next several weeks. If you think the Canadian dollar will be more valuable in the future, you want to buy some before it gets too expensive so you can be ready to sell it in the future when you are sure it will be more expensive. Is this risky? Yes, because there's no guarantee that the Canadian dollar will rise in value. It may even fall. And yet, you can try and use the forward market to your advantage in this case. So let's say I'm a speculator. I have done research, I have looked at many things, I have looked at many data, I have used statistical models, and to the best of my belief, I am certain, I'm confident in my belief about the future value of a currency. So let's represent my belief, the domestic price of foreign currency, as EE dollar euro. This is a belief I form at time t, and it's about a price in t+1. Given this expectation, how can I make money in the forex market? I use the forward market. So, if I have done my research and I look at the domestic price of foreign currency, and I am confident that in the future the domestic price of foreign currency will be kind of high when I compare it with the market's statement about the domestic price of foreign currency, then effectively what I have stated is I think the foreign currency will be very expensive in the future. And I think the market gets it wrong. I think the market doesn't know that the foreign currency will be very expensive in the future. Then what I want to do, because you buy low, sell high, I want to buy this foreign currency at the market's relatively cheap price, and because I have a belief about the future spot price, I will take all this currency that I buy, sell it at this high domestic price of foreign currency, and I will earn profit. Now, if I take my belief about the future value, the future spot value of the foreign currency in terms of domestic currency, and I compare it to what the forward market is saying about the domestic price of foreign currency, and I see that, in my opinion, the forward market prices foreign currency too high in terms of domestic currency, and I think that the foreign currency will be kind of cheap in the spot market, I can again make money from this because the forward market is attaching a very high value to the foreign currency. I want to get in on that by being in a position to sell at this high price. How will I get the currency to sell it? I wait until the forward contract is due. Then I buy the foreign currency in the spot market because I'm confident that the price I believe now will be the price in reality. I've bought this foreign currency cheap. I sell it expensively, dearly. I make profit. You can summarize. When you have the first inequality, where you think that the forward market underprices foreign currency, you go long in foreign exchange. If you think the forward market overprices foreign currency, you go short. Because when you go short, you give something up, you're selling. Buy low, sell high. So this is how speculators can use the forward market as a way to deal or to implement their own beliefs about the future. The changes between a currency's price from one moment to another moment will be effectively the rate of depreciation. And the dollar rate of return on euro deposits will be approximately the euro interest rate plus the rate of depreciation of the dollar against the euro. This second bullet point is effectively what we saw several slides ago up here, where if you were to take the euro interest rate, subtract it from both sides, so you have the interest rate differential equal to the evolution of the value of the currencies, that's what that bullet point meant here. Now, the rates of return would have been similar if we had measured them in dollars rather than in euros. Expected rate of depreciation of the euro against the dollar is approximately the expected rate of appreciation of the dollar against the euro. We would have slight differences in part because we are using this logarithmic approximation. And when you have logs and percents, things don't always work out perfectly. But for the purpose of this class, it's good enough. And this is a table that talks about these depreciations. Final word for this video, I want to return to earlier discussion of general attributes of assets.